Layer 2 is the realm of system-wide regulators, the international bodies that knit more than 200 national agencies into a single rulebook so money can move across borders without detonating the system. Think of Layer 1, central banks, as the power plants. Layer 2 is the electrical code, the building inspector, and the global control room rolled into one. Cross-border finance is only as strong as its weakest jurisdiction. After Lehman's collapse revealed holes in every national regime, the G20 created a permanent coordinator in 2009, the Financial Stability Board, or FSB. The FSB's charter is to spot vulnerabilities, set minimum standards, and police implementation across its 68 members and 24 international organizations. It meets 4 times a year in Basel and reports directly to G20 leaders. FSB, the system architect, publishes the annual work program and issues soft law that G20 jurisdictions are expected to hardwire into domestic statutes. Its 2025 plan flags non-bank leverage, crypto risk, and climate disclosure as top priorities. Standard-setting bodies, or SSBs, write the technical code. The Basel Committee on Banking Supervision, or BCBS, handles capital, liquidity, and leverage rules for banks. Its Basel III Finalisation package, delayed by COVID, now starts on January 1st, 2025, in most major markets. IOSCO, with 130 securities regulators covering 95% of equity and debt markets, has a 2025 work plan that zeroes in on non-bank data gaps, digital broker conflicts, and fin-fluencer risks. IAIS, the insurance supervisors, adopted the Insurance Capital Standard, or ICS, in December 2024, with phased assessments kicking off this year. The Committee on Payments and Market Infrastructures, or CPMI, sets plumbing rules for CCPs, CSDs, and RTGS rails. FATF, the anti-money laundering watchdog, updates its black and gray lists every February. Laos and Nepal were added in 2025, and the Philippines came off. These bodies draft standards, then the FSB checks who actually follows them via peer reviews, thematic scorecards, and naming and shaming reports released every November. Hazard detection, market data, stress test results, and Article Kuiper reports flow into the FSB Secretariat. IMF surveillance provides macro-level risk flags. The BIS supplies funding market intel. Standard design. Experts from over 60 regulators hammer out exposure definitions, capital formulas, and margin schedules. A 20-page Basel term sheet can take 5 years of drafts, field tests, and quantitative impact studies before unanimous sign-off. National transposition. Each jurisdiction must transpose soft law into hard statutes, like CRR3 CAUS CRD6 in the EU, OCC Fed proposals in the US, and PRA rules in the UK. Miss the deadline and your bank's risk equivalence penalties that restrict passporting. Implementation audit. FSB peer reviews rate countries green, amber, or red. Recalcitrants face market pressure. A red flag may raise funding costs or freeze swap line access. Crisis playbook. When shocks hit, the FSB convenes principals in a secure video conference to coordinate bank resolution protocols, swap line terms, CCP margin calls, and, if needed, temporary forbearance on capital buffers. G-SIB list. 29 banks judged too big to fail, each slotted into capital buckets that add 1 to 3.5% on top of Basel minima. The 2024 reshuffle lifted Crédit Agricole to bucket 2 and knocked Bank of America down. Total loss-absorbing capacity, or TLAC. These are debt cushions that let a failed G-SIB be recapitalized over a weekend. Non-bank financial intermediation, or NBFI toolkit. This includes stress tests for money market funds and margin rules for hedge fund repos, closing the loophole that blew up during the 2020 Dash for Cash. Crypto asset framework, finalized in July 2023, calls for same activity, same risk, same rule. Under implementation review this year, FATF lists. These trigger global de-risking. Correspondent banks must apply enhanced due diligence to any counterparty domiciled in a gray or blacklisted state. Layer 2. Regulators possess no tax power and little direct capital. Their influence depends on reputational stickiness and G20 political backing. A sovereign can ignore Basel, but its banks then pay more for wholesale funding or lose access to passporting in other markets. Even the United States, which dragged its feet on Basel III output floors, has now set a July 2025 start date after intense FSB nudging. Climate risk. FSB-sponsored Network for Greening the Financial System is hashing out climate stress templates. IOSCO is drafting assurance standards for ESG data providers. Digital Asset Perimeter, CPMI and IOSCO are aligning stablecoin rules with traditional PFMI standards. FATF is pressuring exchanges on travel rule compliance. AI in Trading and Supervision, IOSCO's 2025 thematic review warns that fractured cross-venue data slows algorithmic abuse detection and calls for cloud-native surveillance. Geopolitical fragmentation, carve-outs from SWIFT, rival payment blocks like CEPs and SPFS, and sanctions screening complicate the dream of a single global code. The FSB now runs quarterly tabletop exercises on payment system cutoffs. Central banks sit on all major SSBs. Their prudential arms enforce Basel and IOSCO rules on domestic turf. When the Fed offers swap lines, it demands that recipient regulators keep local banks inside Basel compliance. Conversely, regulators rely on central bank liquidity to make their resolution regimes credible. TLAC, without a lender of last resort, is an empty promise. Transaction planning. Always test whether counterparties are in an FATF or IOSCO gray zone. Legal counsel will layer additional covenants or margin. Capital strategy, monitor Basel output floor timelines. The 2025 rollout could add 20 to 30% risk weight inflation for model-heavy portfolios. Insurance deals. The new ICS may raise capital charges on cross-border conglomerates. Watch IAIS self-assessments due end of 2026. Securities issuance. IOSCO's retail protection drive is already forcing SPAC, crypto ETF, and copy trading platforms to bolster disclosures. Layer 2 may lack the glamour of trading floors or the brute force of monetary spigots, yet it is the operating system of global finance. Its standards decide who may lend, trade, insure, clear, or custody across borders and on what terms. Ignore it, and a deal that looks perfect on paper can vaporize in a single supervisory letter. Master it, and you navigate the world's capital markets on the firmest legal footing available in 2025.